An American has exactly $10,000 sitting in savings. He has three obvious choices: gold, stocks, or real estate. At first, the decision sounds simple. Just choose the investment that makes the most money. But what if the investment with the highest potential return isn't actually the best choice for the job that money needs to do? What if one investment grows faster, but another protects liquidity? What if one produces income but carries more costs? And what if the biggest mistake isn't choosing the wrong investment at all? What if it's choosing an investment without knowing why the money exists in the first place? That's where this story begins. Daniel is 34. He lives in a mid-sized American city and earns around $90,000 a year working in operations for a logistics company. He has no credit card debt. He already has a basic emergency fund set aside. His job is relatively stable, and he has another $10,000 sitting in savings. The money isn't needed for next month's bills. Daniel is thinking long-term, 10 years, maybe more. He wants the money to have a purpose instead of simply sitting idle, so he starts researching. Three choices keep appearing: gold, stocks, real estate, and each one seems to promise something different. Daniel starts with gold. His father always talked about it. Gold has been used as a store of value for centuries. Investors may buy it for diversification, inflation concerns, or as a potential hedge during periods of economic uncertainty. But Daniel notices something important. Gold doesn't send him a paycheck simply because he owns it. There is no dividend, no rent, no contractual interest. If he owns physical gold, there can also be buying and selling spreads, storage considerations, and potentially other costs. So Daniel asks, if gold doesn't produce income, where does the return come from? The answer is simple. If he eventually sells it for more than he paid, he can make a profit. But that future price isn't guaranteed. Gold can rise, gold can fall, and gold can spend long periods behaving very differently from stocks or real estate. Daniel realizes something else. Gold isn't necessarily designed to win every year. Its potential value may come from doing something different from the other assets. But is doing something different enough? Next, Daniel looks at stocks. Instead of trying to guess which individual company will become the next giant, he considers a diversified stock market investment, such as a broad index fund. Now the story changes. Stocks represent ownership in businesses. Those businesses can generate profits. Some companies distribute part of those profits as dividends. And businesses can potentially grow over time, but there is a price for that potential: volatility. Daniel imagines investing his entire $10,000. Then the market drops 25%. His account could temporarily show around $7,500. Nothing about his ownership has physically disappeared, but the market value has fallen, and Daniel discovers a dangerous question. What happens if he panics? Because an investment plan can look brilliant when prices are rising. It can look terrible when prices are falling. The investment isn't the only variable. The investor is part of the equation too. Then Daniel investigates real estate, and this one is more complicated. His $10,000 doesn't simply buy him a house. A typical property may require a much larger down payment, closing costs, reserves, insurance, taxes, maintenance, and ongoing expenses. So Daniel considers two possibilities. He could continue saving toward a future property purchase, or he could use a real estate investment vehicle that allows smaller amounts of money to participate in property-related assets. Real estate can potentially provide rental income and appreciation, but it also has a major difference: liquidity. Daniel asks, what happens if he suddenly needs the money? A publicly traded investment may generally be easier to sell. Physical real estate can take much longer. And leverage adds another layer. Borrowing can increase potential gains, but it can also increase losses and create payments that still have to be made when property values fall. Daniel is beginning to understand there is no free advantage. Every potential benefit comes with a trade-off. Then something happens that has nothing to do with gold, stocks, or real estate. Daniel's furnace fails in the middle of winter. The repair and replacement cost is about $4,200. Suddenly, the investment question becomes a cash flow question. What if Daniel had invested money that he now urgently needed? A stock investment might be relatively liquid, but its market value could be lower at exactly the wrong time. Gold might also be sellable, but the price and transaction spread would matter. A real estate investment could potentially be much harder to access quickly, depending on how it was structured. Daniel realizes something uncomfortable. The best performing asset isn't automatically the best asset when you need cash tomorrow. The job of money matters. Later that year, the stock market falls. Daniel's hypothetical stock investment is suddenly worth less than it was when he started. He feels the urge to sell, but then he asks himself, did the original reason for investing change? His goal was 10-year growth, not 1-year performance. Selling simply because the market fell could turn a temporary decline in market value into a permanent realized loss. But Daniel also understands the opposite lesson. Holding an investment forever isn't automatically correct either. The investment still has to fit his goals, risk tolerance, and time horizon. The real question isn't, did the price fall? It's, has the reason he owns this investment changed? Daniel keeps researching. Then he discovers another problem. A 7% return isn't necessarily a 7% result. Fees matter, taxes can matter, trading costs can matter, inflation matters. Gold can have purchase and selling spreads, and with physical ownership, storage considerations. Real estate can involve property taxes, insurance, maintenance, management costs, and transaction expenses. Even a small annual cost can become meaningful over a decade. Daniel realizes the return printed on a chart isn't necessarily the amount that ends up in his pocket, so he asks, what matters more, the advertised return or the return after all the costs? 5 years pass. Daniel looks at the 3 paths using purely illustrative assumptions. Suppose his $10,000 stock investment compounds at an average 7% annually before taxes and fees. After 5 years, it would be roughly $14,000. Gold could be above or below its starting value depending on the period. Real estate could show appreciation and potentially income, but the result would depend heavily on structure and costs. There is no honest way to create a universal 10-year winner without defining exact assumptions. So instead of which one wins, Daniel asks, what is each one designed to do? This becomes the biggest discovery of all. Imagine Daniel chooses stocks, then sells during a crash, or buys gold after a rally, then sells after a decline. Or constantly moves money toward whichever asset performed best the previous year. The original investment choice may become less important than his behavior. The same thing can happen with real estate. Buying because everyone else is buying isn't a strategy. Neither is buying because the price recently went up. An average investment held with discipline can sometimes produce a better outcome than a great investment handled emotionally. Discipline doesn't mean ignoring risk. It means understanding the risk before committing the money. 10 years after the original decision, Daniel looks back. Under one set of assumptions, diversified stocks may produce stronger long-term growth. Under another environment, gold may provide useful diversification. A suitable real estate investment may potentially provide a combination of income and appreciation, but each comes with different risks. Change the starting point, the fees, the taxes, inflation, the return, the time horizon, and the result can change too. That's not a weakness. That's the reality of investing. Daniel realizes he was asking the wrong question. The better question is, what job does this $10,000 need to perform? That's the wealth nest approach. Don't just ask where your money can grow. Ask what job your money needs to do.